I think, HSBC shares fell about 4% yesterday, but I think a lot of that was actually driven by its subsidiary Hang Seng Bank, where that's really where the problems that were unexpected a bit in commercial real estate this quarter came up, and Hang Seng shares were down more than 7%. And for Hang Seng Bank, I had been expecting credit costs for this year to be around 50 basis points of loans. But on an annualized basis in the first half, they were actually like 120 basis points. And Hang Seng Bank commented that the second half might be similar to the first half. So I think it was definitely higher credit costs than I had been expecting, and probably if we look at the market reaction, and then the market had been expecting. But in terms of, so is this new information about the commercial real estate market? I think I came to the conclusion that a little bit that it is, a little bit, but mostly we should remember that this is, I think the market, the equity market going ahead of earnings had maybe overshot, and, is kind of a recalibration back to reality, is that we know that the commercial real estate market in Hong Kong, has oversupply, that it's in a difficult position. We've seen, a lot of these even larger developers that have had to work with lenders in terms of refinancing their debt, but and especially the mid-tier and smaller developers. We knew there were problems there, so in that sense, it's not really a surprise for Hang Seng Bank. But that said, I think the magnitude that came through shows that the situation is a bit more severe than we had been expecting.
So how big of a concern is asset quality for the banks in Hong Kong?
It's certainly for the Hong Kong banks, property lending for real estate investment, is a major pillar of earnings. For the global banks such as HSBC and Standard Chartered, for which Hong Kong is one of their markets, then the exposure to the overall bank is less than it would be for the local banks like Hang Seng, or the smaller some of the smaller banks in Hong Kong. So it definitely is an issue. I think we've seen this in the earnings in recent years, that Hang Seng Bank, prior to the pandemic, it is a very cost efficient bank and remains very cost efficient. Delivered very good earnings for many years. And it's at a level now where ROE is, say, 9% or so, which is lower than the double digits they used to earn. And I think this will probably continue for the time being. So I think that's the level of concern. But the main thing here is that the banks, I think, are a bit of a lagging indicator relative to the property market itself. Is that once these problems come through, they'll show up in the bank earnings a bit later, and I think that's what we're seeing.
All right, property market is one thing. What about the mainland banks? Because HSBC and StanChart both have exposure. Bank of Communications for HSBC, and a $2.1 billion impact in this reporting period. We saw back in February of last year, the $3 billion impairment sent the shares tumbling 10% because of bad loans in China at the time. Now, we know for Standard Chartered, they have exposure to Bohai Bank. So what about the mainland bank exposure?
So I think for HSBC, the write-down on its stake in BOCOM this quarter, they had probably had expected that it would be seen as a one-off, and that actually, if I take out the BOCOM write-downs and exposure this quarter, I actually think HSBC's earnings were pretty solid. And I think it was kind of the narrative, once we had that negative surprise from Hang Seng Bank, which of course is consolidated in HSBC. I think that's part of why we saw the share price reaction yesterday. In terms of Bank of Communications, this write-down is not related to commercial real estate in mainland China. This is, most of it was due to dilution because of the government capital injections, and HSBC didn't participate, so its stake goes down. And then I think they took the opportunity. Their model also had that they took an impairment on the carrying value at the same time, but it's kind of a non-cash loss. And I think in terms of mainland commercial real estate exposure for the Hong Kong banks, most of that worry, I think, is past. And I think the worry is really more centered on the local Hong Kong commercial real estate market.
Now, HSBC prides itself as being the best trade finance bank, and we're talking about trade on a daily basis with Trump's trade war. How is HSBC exposed?
I think, given its, the portfolio of countries and trade corridors that HSBC and Standard Chartered have, that they're not, very reliant on the corridors just to the U.S. and other countries. I think, they have many multiple corridors, and many of them are. So yeah, certainly, HSBC and Standard Chartered, we have between Greater China and Southeast Asia, also Middle East and China. But HSBC management also spoke that the UK now has a new trade deal with India, and of course HSBC is well positioned on both sides of that. So I think for the banks, when we have tariffs and it creates trouble for their borrowers or disruptions for their borrowers, it actually can be an opportunity for the banks, because if they're well positioned to help their borrowers navigate. So I don't think the tariffs themselves will have that much negative impact on either HSBC or Standard Chartered.
What about the search for a new chairman? We know that Mark Tucker will be headed back to AIA now as the new chairman there come October. What about HSBC?
Well, that's something we couldn't ask the management about, since the management reports to the board themselves. But it's certainly, I think, a question on investors' minds. Sir Mark Tucker will leave in September, and we don't know yet who might replace him as chairman. And I think it matters, because we saw this with Mark Tucker, that the chairman, although the chairman is not the CEO, the chairman does have a lot of influence over the kind of the strategic direction, or the what sort of strategic direction the CEO will take. And as you're probably aware, some of the HSBC's mainland, or I would say Chinese or Asian investors, after the pandemic, were not entirely happy or satisfied with how it had been strategically positioned, or dividend policy, this sort of thing. And the HSBC, I think, is management has said that they're they need, while they're making adjustments, basically the current business model is the correct one. And then so George Elhedery, the new CEO for a year, has been kind of delivering on that simplification, but sticking with the general business model. So I think whoever is named as chairman will be important to determine how the bank may look at the kind of the overall strategy.
Yeah, it was a Ping An Insurance that was not happy. George Elhedery now, since he's come in, has announced this huge overhaul to the business structure. Corporate and institutional banking was the biggest revenue center, but also only one of the 4 business lines that saw profit increase. Is what George is doing now, was it a good move?
I think it certainly is, simplification is what's on order, and HSBC is a very complex and large institution, and a very speedy or radical simplification does have disruption risk. So I think it's quite intensive and quite sustained, and it may be just what HSBC needs. But in terms of getting the cost savings from it, you have upfront cost, you have severance, and really you won't see the cost savings, on a net basis work through until next year at the earliest. So I think this is a bit of a window where, George is making actions, but he can't immediately point to how it's showing up in results. And it just has to say, kind of, hold on, it's going to come through. And I think that's the situation we're in right now.